Stuart, thank you very much. I'm very impressed by the fact that we should be trending on Twitter at the moment. You did tell us, though, to turn off our mobile phones. So I'm not quite sure how we can tweet and trend at the same time. Trend at the same time. I did go to a conference where we did have a Twitter, and there were Twitter tweets coming through, except we were in a mobile-free zone. So I couldn't quite work out how genuine these tweets were. Stuart, thank you very much for inviting me to this conference this morning. And we meet at a time, as Andrew said, of unprecedented change for the financial system. And it's absolutely vital, I think, that governments, regulators and companies continue to work together through these challenging times. We face the substantial long-term task of strengthening the financial system for the future, learning the lessons from the recent years of financial and economic instability that have affected economies around the world. It's only by doing so that we can ensure we build a platform from which the UK can build on its strengths in financial services, strengths which include London consistently ranking first in the Global Financial Centres Index, ranking's most attractive destination in Europe for investment, according to Ernst & Young, a financial services sector that originates more cross-border bank lending than any other country, home to Europe's largest insurance and asset management industries, and the world's largest foreign exchange market, and a sector that is home to over 250 branches and subsidiaries of foreign banks, channeling more investment into the UK than any other sector. Now, we're committed to maintaining and strengthening the UK's role as a leading global financial centre because we know the vital role that the sector plays in our economy, contributing £1 in £7 of our GDP, employing nearly 2 million people in financial and related professional services across the UK, two-thirds of them outside the M25, and helping UK companies raise almost £450 billion in funding since 2005. The strength of the UK's financial sector, though, and our dependence upon it, presents us with the challenge which the Chancellors have referred to as a British dilemma. How can we create a successful but stable financial services sector? How can we preserve the innovation that fuels the sector's success without putting the wider economy at risk, achieving what Andrew referred to earlier as support from the voters for the financial services sector? Now, our answer to the British dilemma is to build a strong and proportionate regulatory regime, safeguarding the stability of our financial sector as a foundation for sustainable growth and protecting the competition and innovation that drives its success. Now, I don't believe that strong and proportionate regulation is a hindrance to the success of financial services in the UK. Rather, I think it is an essential platform for a successful global financial centre, ensuring that the UK remains an attractive destination for international business, a place where businesses can trade with each other with confidence. So we're pursuing an ambitious set of reforms to address the lessons of the financial crisis and to safeguard London as a global financial centre. Central to this programme is reform of the regulatory architecture, abolishing the failed and discredited tripartite system of supervision. In its place, a new prudential regulatory authority, an independent subsidiary of the Bank of England, which will take responsibility for microprudential regulation, and a new financial policy committee sitting within the Bank of England, which will monitor risks across the financial system, and its purpose will be to identify bubbles as they develop, spot dangerous interconnections across the system, and stop excessive levels of leverage before it's too late. And together, these bodies will bring judgment and foresight to the task of supervision, rather than mere box-ticking. At the same time, it will also take into consideration the impact on economic growth when pursuing financial stability, not neglecting the fact that stability itself is a precondition of economic growth. The legislation to achieve this critical change in the way British banking operates had its second reading in the House of Lords yesterday, and we expect it to receive royal assent by the end of this year. Now, as well as ensuring that the UK's regulatory institutions are fit for purpose, we are addressing some of the structural issues within the banking sector itself, the issues that caused so much trouble when the crisis hit. The UK has taken significant steps to improve bank resolvability and address the too big to fail issue through the Independent Commission on Banking. Reforms that are ambitious in their scope and proportionate in their impact. We've already committed to implement the Commission's recommendations to ring-fence investment banking practices from retail banking, ensuring that when a bank fails, services that are vital to families, businesses and the whole economy can continue without resort to taxpayers' money. We've already committed to introduce additional loss absorbency requirements on ring-fenced retail banks, ensuring that the large retail banks hold equity capital of at least 10%, with the minimum loss-absorbing capacity for the bigger banks of at least 17%, to ensure that shareholders and bondholders bear the cost of failure, not taxpayers. And later this week, the government will produce its white paper setting out the final proposals for further reforms to the UK banking sector, based on the ICB's recommendations. Now, of course, financial services are an international industry, and regulation has to reflect that reality. So it's right that much of the debate on regulatory reform is being driven at an international level. Now, against the backdrop of continuing instability in Europe, it's critical that we seek regulatory reform that ensures stability, creates opportunities for sustainable growth in the future, and removes the distorting effect of arbitrage. Abroad as at home, we need to tackle the issue of too big to fail and the perceived implicit guarantee of financial institutions that continues to distort fair and open competition globally. Through the G20, we've agreed that supervisors need to be able to go further to address the risks posed by the largest and most interconnected banks. This means applying additional loss absorbency requirements to further reduce the risk that these high-impact banks fail. Developing internationally consistent recovery and resolution plans that will require firms to take early action to generate capital and liquidity in stress. And ensuring that supervisors have the tools that they need to intervene early and ensure an orderly resolution where a bank does fail. And the UK is leading the way in development of these toolkits. On RRPs, we've already started a pilot project with 6 of the largest UK banks. We expect all banks to develop their own plans by the end of this year. Reforms to tackle the interconnectedness of banks are therefore vital. And we only need to look across the channel to understand the magnitude of interconnectedness, not just between banks, but between banks and public finances, and between public finances and monetary unions. Now, the Eurozone crisis needs a response that deals with specific weaknesses in the governance of the single currency. We have for some time argued that the remorseless logic of monetary union requires closer fiscal integration in the Eurozone. As the Chancellor wrote this weekend, we chose not to join the Euro precisely because we'd lose national sovereignty and control of our monetary policy. A banking union, though, is a necessary part of the fiscal and monetary union that the Eurozone is committed to. That's why we won't be taking part in the banking union. Britain's place is in the internal market, not in the Eurozone bloc. As the Eurozone integrates, so Europe will have to ensure that it does not do so at the expense of the single market, one of Europe's greatest achievements. A Europe that achieves Eurozone stability at the cost of the single market would undermine the benefits that have been achieved through a diverse and ever-widening market that promotes competition, offers choice, promotes opportunities for growth, investment and jobs. But abroad as at home, we must also be mindful of the impact that inconsistent, discriminatory and disproportionate regulation can have on stifling growth, restricting investment, lowering business returns and imposing higher costs on investors. That means ensuring that regulation is based on evidence and rigorous analysis, ensuring that internationally agreed regulatory standards are implemented fully and consistently at an international level, and ensuring that regulation protects the open and competitive markets that are critical to fostering renewed growth across all our economies and vital to London's continuing success as a global financial centre. That's why the UK is taking on a lead role in financial services reform, both internationally and in Europe. Full, consistent and non-discriminatory implementation of these agreements is essential to ensure the stability of the international financial system, but also to protect free and open competition that allows all our sectors to thrive. And what we see at the moment is a whole array of dossiers being in discussion in Europe, where we are securing agreement and supporting the Commission in its vital role to uphold single market principles that are vital to support economic growth. For example, I think it's vital that derivatives in any currency can be cleared in any country. So on EMIR, we've worked hard to ensure clear recognition of the principle of non-discrimination in Council. That's also why we're challenging the ECB's location policy in the European Court of Justice. And on MiFID, we continue to make the case against unnecessary barriers to trade within the EU and between the EU and third countries. London thrives not just through trade within Europe's borders, but also through trade outside those borders. On the basis of the current MiFID proposals, it seems that no third country would meet EU rules. So from the moment that MiFID is passed until equivalence decisions are taken, it would close the EU market entirely to any new third country firm, as well as choking off opportunities for our firms in some of the most strongest and fastest growing emerging economies. So we couldn't trade with a new Japanese security house, or seek capital from China, or invest in Africa. And it is worth reminding ourselves that EU financial services are a powerful force in the international market, accounting for a quarter of financial services exports overseas and responsible for managing just under half of global bank assets. So at a time when we have to do everything we can to attract investment to support economic recovery in Europe, we cannot afford to cut ourselves off from the rest of the world. Now, of course, this works both ways. We have to resist proposals that seek to raise barriers to UK or European investment in the rest of the world, which is why we're concerned, along with many other countries, about the extraterritorial application of the Volcker rule as currently drafted. There is a significant risk that the rule will restrict US banks from trading in non-US sovereign debt, and a risk that non-US banks may be restricted in their ability to transact with US investors. I think it's absolutely vital that as we strengthen the global regulatory framework, we do so in a way that balances stability with the maintenance of global markets, sustaining economic growth. It's equally important that we act to strengthen and safeguard UK financial services, ensuring that we maintain the pole position which I mentioned at the start of my speech. Protecting the businesses and families that rely upon a vast range of financial services and expertise, foreign exchange and commodity markets, maritime and trade finance, insurance and reinsurance, and much, much more besides. And ensuring that the UK financial services are able to access markets beyond Europe, when half of our services trade is with countries outside Europe. We must ensure that European regulation does not risk the opportunities we enjoy from key international growth markets at a time when we so desperately need inward investment. So as I said at the outset, London is a global financial centre, and we're committed to supporting and maintaining the UK's position as the world's leading financial services centre. And we're committed to attracting the world's most ambitious and innovative financial services companies to the UK. And I believe to achieve that, it's essential that we reform regulation to remedy the failures of the last decade, safeguarding an innovative and successful financial services sector without putting the wider economy at risk. But to do that, government and regulators can't act by themselves. We need to work with the industry too, to realise that ambition, to embed proportionate, consistent and non-discriminatory regulation, to promote a competitive, stable and above all a successful financial services sector. Thank you very much. Now, so are you comparing questions or shall I?
No, I think you're going to compare questions, but if you don't mind, there are a few people standing at the back, and if they want to come down, there are some spaces here whilst you invite questions.
Right, who'd like to ask a question? Unless you tweeted it already. It's a very shy audience this time of the morning. Yes, gentleman at the back.
Is that working? Good.
Yes.
Richard Hobbs-Lansons. Your colleague Mark Prisk is responsible for deregulation across all Whitehall departments. And he told me the other day he covered the Treasury as well, but I should talk to you about deregulation in financial services. And I wondered what you were doing to create the space in the FSA handbook for all the new regulation you want to bring in on banking and other things, which is appropriate, but where is the space going to be created? Otherwise, the handbook will just grow and grow like Topsy.
Well, I think what's important is that the regulation, and whether that's through from Europe, or whether it's from government or from the FSA and its successor bodies, is proportionate. And what we need to do, I think, is to ensure that the regulatory framework in which businesses, financial services businesses operate on, is kept under review. And is looked at very carefully to ensure that we have rules that are fit for purpose. You know, I think one of the challenges, we're seeing this in Europe, and partly through the volume of regulations coming through, part of it is trying to address the problems of the crisis, but part of it also is to keep at pace with market developments. And you know, we are seeing in ever more sophisticated financial markets set of financial markets across Europe, and particularly in the UK. And we need to make sure the rule book remains fit for purpose in dealing with that. And I think it's important to ensure that where possible the FSA scales back its rules if that's the right response, but also to make sure the rules are proportionate, they tackle the issues they're trying to tackle, don't impose excessive costs on business, because those costs are so often borne by consumers, either through higher costs or through less choice. So we need to make sure the rule book is consistent and proportionate, and they are duties that are set out in the Financial Services Bill that are going through the House of Lords at the moment. Who's next? Yes. Would you like to use the microphone that's lurking there? Yeah.
Thank you. Are any other countries going to embrace ring fencing or 17% capital for banks? And if so, why?
Well, I mean, I think that what we sought to do is to address a particularly British issue, that the size of our banking system is significantly larger than our economy, and that we need to ensure that that banking system is able to compete and to be innovative without posing a threat to economic stability. And I think that the measures that the ICB have put forward respond to that British dilemma. I think it's a matter for other countries to decide what measures they think are appropriate for their economy. And of course, the European Commission, in responding to Vickers, set up a high-level group under Eric Lignan to look at some of these issues on a Europe-wide basis. But our strategy has always been to secure the flexibility within CRD4 to enable us to implement Vickers without imposing it as a model on others. I think it's a very British answer to a very British problem. Yes, gentlemen.
Thank you very much. David Gardner from KPMG. You recognised quite rightly the importance of the UK continuing to be a global hub for financial and professional services and to become more competitive. And you went through many of the regulatory issues, which is very important. But part of being a global hub and remaining globally competitive is obviously that the UK remains globally connected, and that the global talent from around the world can easily come to the UK to work for global banks and other financial and professional companies. What's the government policy on that, and are you concerned about perceptions on both those scores have been under threat in the last couple of years?
Well, I think there is a challenge to make sure the UK is a destination of choice for people in what are very mobile businesses. And we do face some challenges. And one of the things I recognise, we have made significant changes to modernise our corporate tax systems to ensure that by 2015 we'll have the lowest rate in the G7 and the fourth lowest rate in the G20. But the message that we got very strongly from international businesses was low corporation tax rates were important, but not enough in themselves. And that's why in the budget, something that is much overlooked in the furore about pasties and caravans, is that we took the decision to cut the top rate of tax from 50 pence to 45 pence to send a very clear signal to mobile international employees that actually the UK was a place to do business. But what we also need to do, I think, is look at some of the infrastructure issues. We're investing heavily in Crossrail, which is disrupting all our lives in the city, but will provide a huge step change in transport capacity in London. And one of the things we're doing at the moment is conducting a review of airport capacity in the southeast as well, to understand what we can do to make better use of the capacity we have and understand how we need to adapt to a future change in air travel as well. But I think the other point you were alluding to in your question was about immigration rules. And I think it's a very difficult balance to strike here, trying to make sure we have the right rules in place to attract talent, to encourage, for example, intra-firm transfers, to enable the highly skilled employees to come here, but also to tackle some of the immigration loopholes that have opened up over the course of the last 10 or 15 years. And I think we're getting that balance right in government, but it's important that we tackle the misuses of immigration rules at the same time as we ensure that those people who we want to come in, who are key to the future of London's financial services centre, are able to do so.
I'm afraid, Minister, that's when the time is against you. So on behalf of all of us, thank you very much. Leave you now to address those challenges. Thank you.
Thank you very much.